It's time now for our Muni moment, and our next guest says now is a good time to turn constructive on municipals. This is after the markets backed off from a 5% yield on the 10-year Treasury. Sean Carney joining us right now. He's head of municipal strategy over at BlackRock, and there's been so much focus, Sean, of course, on the rally that we saw in Treasuries. I think a lot of people miss the rally that continues to go on even today in munis. How sustainable is that?
I think it has legs, Romaine. I mean, last week was a pivotal week for fixed income and in particular municipal bonds. I mean, you started off with the Treasury funding, which was a large hurdle for the market to get over, as well as the Fed, and then some soft economic data. So, yeah, as you stated, the market has rejected 5%. We've rallied pretty well. A nice auction today, and it feels like the market is finding a home closer to 450 on 10-year Treasuries as opposed to 5%, which is welcome for a market that has just seen a long period of higher and higher yields.
And it's interesting, too, because when you start to see the rally that we've had over the last, whatever it is, 7-day stretch or whatever, and then you go back to the beginning of the year where we saw a lot of strength in munis, and then that kind of faded here. What's sort of that in between what we saw at the beginning of the year and what we see now? What exactly changed investor sentiment?
That's right. So, people came into the year thinking, okay, 2022 is behind us. Let's look forward to 2023. And we got somewhat of a head fake. Munis started to perform very well in the beginning of the year with inflows coming in, good performance, which took the broad muni index up to 4% in April. And then all of a sudden, the Fed narrative started to turn. They started to get a bit more hawkish. Data started to pick back up. Maybe inflation wasn't under control. And then you have this low and slow move towards higher yields. It wasn't really the muni market itself that was experiencing the issues. It was, the muni market was rather fundamentally sound. It was more of a rates problem that the market was undergoing because, as you know, Romaine, the muni market is a long duration market. So as the Fed's tone began to turn a bit last week, and perhaps we've seen the last Fed rate hike, the market has now taken a bit of comfort in that and is now focusing on the data a little bit more. So I think that's the narrative change that we're talking about.
Well, now as we start to see demand maybe come back, maybe as rates start to stabilize in the Treasury market, through what avenues is that coming? Because as you point out in your notes, I mean, when you look at mutual funds, you've seen outflows, then you look at separately managed accounts, you look at ETFs, you're seeing pretty hefty inflows. How do you explain those different traffic patterns?
Yeah, it's a great question because it's a big change from what we've seen in past years. The traditional flows came in through open-end funds, which is what the industry measures on a weekly basis. And what we've seen over the past 2 years is more money from retail has been coming in through separately managed accounts, SMAs, and ETFs. And because we measure mutual funds, seeing outflows week after week after week, the market is indicating that with 4 times over subscriptions in the primary market and rather good retail demand, that there's a bit of a mismatch here. So we're looking at our SMA platform, our ETF platform, having good inflows while mutual funds are still seeing some outflows. I do think as people begin to focus again on all-in yields, money will come back into the mutual fund space. Traditionally comes back in high yield first and then moves itself into IG. But with a Muni main index north of 420 that tax adjusts up above 7%, and a Muni high yield index 6% that tax adjusts above 10, I think the all-in yields are just too high to ignore here, and I think we're about to see money back into mutual funds here in short order.
Well, Sean, it's so interesting to me because this is something you're seeing across the asset management landscape. Again, money coming out of mutual funds, going into ETFs. And from where you sit at BlackRock, looking at this develop in the muni market, do you think that the money coming into ETFs is new money into the muni asset class as a whole, or is this maybe a rotation going on from one wrapper to another?
Yeah, I think it's a combination of both. I think some of it could be new money coming in. However, I think that a decent amount of it may also be some tax loss swapping that tends to take place in the back half of the year. People selling some of those underperforming mutual funds, parking cash into ETFs, and then rotating back out, early in the following calendar year. So I think some of it's some new money looking to come into fixed income at today's yields, and then some of it is also that tax loss swapping that we know takes place later in the year. And that speaks to a couple of things, both the demand, the elevated bid wanteds that we've been experiencing in our market. It lines up very well with that narrative.